what I'm going to be doing here today is trying to explain and answer the question of what does it mean when people say don't fight the Fed. I'm realizing I should probably introduce myself as well, since I haven't had an opportunity to meet all of you yet. My name is Jeff Gardner. I joined MFG back in July of 2017. I'm actually originally from Canada. I grew up there and came to Indiana, to the University of Indianapolis on a golf scholarship, where I met my wife, Allie, and I'll see if I can get a picture on here. Yeah, there she is. Isn't she lovely? And here's also a picture of our two dogs, Sadie and Kaya. Anyway, so living down in Indiana now, joined MFG in 2017. And here we are today, a few years later. So although we do put out blogs periodically, we would like to start sending out some videos as well, just because they might be a little bit more engaging. People might be more likely to watch them versus reading the blog. So the term "don't fight the Fed," although it often rings true, should not be taken as the end-all be-all investment advice. Generally speaking, it's a good idea to increase your stock exposure when the Fed is loosening policy or increasing the money supply, and it may be a good idea to lighten up on your stock investments when the Fed is tightening policy. That's just an old adage rule that people throw around, and it's something that's been talked about a lot recently because, as I mentioned, the stock market is roaring while we look around and it doesn't seem like the economy is doing too well. So there seems to be a disconnect there. And a lot of people are just chalking that up to the Federal Reserve and also fiscal stimulus coming from Congress and from the government. So why ultimately are lower rates good for stocks? I'll try to explain that a little bit. There's really two big reasons. One is the cost of borrowing, and two is the methods of valuing stocks and how analysts or investors actually arrive at a price target for a company. So the first one, cost of borrowing, how does that play into things? If you think about it, say you're a business owner and you can borrow money at a rate of 5%. So you've got this debt on your balance sheet that you have to pay a 5% interest rate on. And that's an expense that's part of your business. But what if that expense was 4%? Or what if it was 3%? You're spending less on interest as the rates fall. So that means you then have more money you can spend on marketing or research and development. As the owner of the business, you get to decide how to allocate that extra capital. Some businesses might pay it out in dividends. It all is up to the management of the business for stocks. The second is the way analysts and investors actually value a company. A common method is the discounted cash flow method, which looks at the future cash flow that a business will produce and discounts that back to the present day. And the cost of debt is a very important variable in the discount rate used. And so as just the simple math behind it, as that cost of debt falls, the current value of that company increases because of their cash flows expanding. So hopefully that makes sense. I'm not going to dig into the specific details about the weighted average cost of capital, which is what's used as the discount rate. So that's the second reason, is if nothing changed at the business except for the fact that analysts now are using a lower cost of debt in their pricing models, that would increase the perceived market value of a business just by the math behind the calculation. So those are two primary reasons why lower interest rates are good for stocks. Another factor is if you get inside the head of an investor and you think about opportunity cost. So what do I mean by opportunity cost? Is when you spend money on something or invest in something, you are giving up the opportunity to use those dollars for something else. So from an investment standpoint, a prudent investor is constantly evaluating you know what, where's the best place for me to allocate my available capital? Should I put that into stocks? Should I put it into bonds? What's going to give me the greatest return on my investment? And what are the risks associated with those investments? So say you're looking at a bond that's paying a coupon rate of 3%, and you're looking at a stock that you expect to return about 10%. You decide, do I want to take the risk of the stock in order for potentially increasing my return, or do I want to go with the bond because it's a little bit safer, so to speak, in exchange for a 3% coupon? That's the decision process with any investment you're making, is evaluating where is the best place to put my money. But then what happens if the yield or the coupon rate on the bond drops from 3% to 1.5%? That becomes a much less attractive investment than it was when it was at 3%. So now you're deciding, the trade-off looks a little bit better to be investing in the stock. And that's another factor that's playing into the markets right now, is folks looking for a return on investment. They want to increase their purchasing power, and stocks might look a little better than bonds as yields fall. Anyways, hopefully this has been helpful for you, and maybe you've even learned something new from watching this video. Ultimately, the goal was to try and shed some light on that term, "Don't fight the Fed." So hopefully you have a better understanding of what that means and why people say it. Next time, this is the first one of these videos that we've done, so we'll see if people enjoy it, see what kind of feedback we get from you guys. And if you'd like to have more of these going forward, or if you prefer the blog, just let us know. That way we can know how best to serve you. Thanks.